In this video, I will be explaining the BBA third semester subject Financial Management as prescribed by Osmania University and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 3 first important short question is: explain the features of equity shares. Features of equity shares. Equity shares are the ownership shares of a company. When you buy them, you become a part owner. Here are the main features in simple words. 1. Ownership rights. Equity shareholders own the company and can vote in important decisions, like electing directors. Example, if Ram buys 100 shares of XYZ Ltd, he has voting rights in the company's meetings. 2. Residual claim. They get profits, dividends, after paying all debts and preference shareholders. If profits are 1 lakh rupees and debts are 50,000 rupees, equity shareholders share the remaining 50,000 rupees. 3. Risk and return. Equity shares are high risk, high reward. Dividends may vary depending on profits, unlike fixed interest debentures. 4. Limited liability. Shareholders are responsible only up to the value of their shares. If the company fails, they won't lose more than what they invested. 5. Transferability. Shares can be sold or transferred easily in the stock market. 6. Voting rights. Equity shareholders usually get 1 vote per share, giving them a say in company policies. 7. No maturity. Equity shares are permanent capital, meaning the company does not have to repay the principal like a loan. Example to remember: think of equity shares as owning a slice of a pizza. You enjoy your share of toppings, profits, but the size of your slice can change depending on the overall pizza size, company's profit. These features make equity shares flexible, risk-bearing, and rewarding for long-term investors. Next important short question is: to explain the features of debentures. Features of debentures. Debentures are long-term debt instruments issued by a company to raise funds. Unlike equity shares, they do not give ownership in the company. Here are the main features in simple words. 1. Fixed interest. Debenture holders get fixed interest, coupon, regularly, regardless of the company's profits. Example, if a debenture has 10% annual interest and you hold 1,000 rupees, you get 100 rupees per year. 2. No ownership rights. Debenture holders are creditors, not owners. They cannot vote in company matters. 3. Repayment of principal. Debentures have a fixed maturity date, and the company must repay the principal at the end of the period. 4. Secured or unsecured. Some debentures are secured by company assets, safe, while others are unsecured, riskier. 5. Tradable. Debentures can often be sold in the market, giving liquidity to the investor. 6. Priority in payment. Debenture holders are paid before equity shareholders in case of company liquidation, reducing risk compared to equity. Example to remember: think of debentures like lending money to a friend with a promise: you'll get fixed interest every year and your money back on a specific date. You don't own any part of the friend's business but get priority repayment if something goes wrong. This makes debentures safe, predictable, and attractive for risk-averse investors. Next important short question is: 3. What do you mean by weighted average cost of capital? Weighted average cost of capital, WACC. Weighted average cost of capital, or WACC, is the average rate of return a company must pay to all its investors, both debt holders and equity shareholders, based on the proportion of each in the company's capital structure. It shows the overall cost of raising funds. Key points. 1. Weighted, each source of finance, debt, equity, preference shares, is considered according to its share in total capital. 2. Cost of debt, interest paid to lenders after tax is included. 3. Cost of equity, expected return demanded by shareholders is included. 4. Purpose, helps in deciding whether a project's return is higher than the cost of financing. Example, suppose a company has debt is equal to 40 lakh rupees at 8% after tax. Equity is equal to 60 lakh rupees at 12%. Total capital is equal to 100 lakh rupees. WACC is equal to 40 by 100 times 8% plus 60 by 100 times 12% is equal to 10.4%. So, the company must earn at least 10.4% on its investments to satisfy all investors. Easy to remember, WACC is equal to average cost of all money the company uses. Cheaper funds lower WACC, expensive funds increase it. Next important short question is 4. Dividend policy decision. Dividend policy decision. A dividend policy is a company's strategy to decide how much profit should be paid to shareholders as dividends and how much should be retained in the business for growth. It balances shareholder satisfaction and business needs. Key points. 1. Types of dividend. Cash dividend paid in cash. Stock dividend paid in shares. Special dividend, one-time extra payment. 2. Determinants of dividend policy. Company's profitability and cash flow. Future investment plans and growth opportunities. Shareholder expectations. Legal and tax considerations. Example, suppose a company earns 10 lakh rupees profit. It may pay 4 lakh rupees as dividend, 40%, and retain 6 lakh rupees for expansion. Easy to remember, think of dividend policy as a profit-sharing plan. It decides how much to enjoy now, dividend, and how much to invest for tomorrow, retained earnings. This ensures the company keeps shareholders happy while supporting business growth. Next important short question is 5. Explain the components of costs of capital. Components of cost of capital, explained simply. Cost of capital is the average rate a company pays to finance its business through debt or equity. It shows the minimum return expected by investors. Main components. 1. Cost of debt, KD interest paid on loans or debentures, after tax. Example, a 10% debenture with 30% tax has KD is equal to 10 times 1, 0.3 is equal to 7%. 2. Cost of preference shares, KP dividend paid to preference shareholders divided by net proceeds. Example, 100 rupees preference share paying 8 rupees dividend, KP is equal to 8 by 100 is equal to 8%. 3. Cost of equity, K return expected by equity shareholders, often calculated using dividend discount model or cap. Example, dividend 5 rupees, share price 50 rupees, K is equal to 5/50ths is equal to 10%. 4. Cost of retained earnings, opportunity cost of reinvesting profits rather than paying them as dividends. Usually similar to cost of equity. Easy to remember, think of cost of capital as a price of funds, what the company pays to borrow, issue shares, or retain earnings to run the business. It helps in investment decisions, capital budgeting, and maximizing shareholder wealth. Next Unit 3. Long questions. First important long question is: define preference shares. Explain the features and different types of preference shares. Preference shares definition, features and types. Definition. Preference shares are a type of share capital that gives shareholders preference over equity shareholders in receiving dividends and repayment of capital during winding up. Unlike equity shares, they usually do not carry voting rights but offer a fixed rate of return. Features of preference shares. 1. Fixed dividend. Preference shareholders receive a fixed dividend before any dividend is paid to equity shareholders. Example, 8% preference share of 100 rupees pays 8 rupees annually. 2. Preference in capital repayment. In case the company is wound up, preference shareholders are paid before equity shareholders. 3. No voting rights. Normally, preference shareholders cannot vote in company decisions, except in special circumstances. 4. Redeemable or irredeemable. Some preference shares can be redeemed after a fixed period, while others are perpetual. 5. Cumulative or non-cumulative. Cumulative, missed dividends are carried forward. Non-cumulative, missed dividends are not carried forward. 6. Convertible or non-convertible. Some can be converted into equity shares after a certain period. Types of preference shares. 1. Cumulative preference shares. Dividends accumulate if not paid in any year. 2. Non-cumulative preference shares. No accumulation of unpaid dividends. 3. Convertible preference shares can be converted into equity shares after a specific period. 4. Non-convertible preference shares cannot be converted into equity shares. 5. Redeemable preference shares must be repaid after a fixed period. 6. Irredeemable, perpetual, preference shares never repaid, dividend is paid indefinitely. 7. Participating preference shares may receive extra dividend beyond the fixed rate if profits are high. 8. Non-participating preference shares only get the fixed dividend, no extra. Easy way to remember. Think of preference shares as VIP tickets. In a company, you get priority in money, fixed rewards, but no say in decisions, unless rules allow. They are a hybrid between debt and equity, safer than equity for investors, but more flexible than loans for the company. This knowledge is important for deciding sources of long-term finance and understanding how companies raise capital efficiently. Next important long question is: 2. What do you understand by capital structure? What are the major determinants of capital structure? Capital structure, meaning and determinants. Meaning of capital structure. Capital structure refers to the mix of different sources of long-term finance that a company uses to fund its operations and growth. These sources typically include equity shares, preference shares, debentures, long-term loans, and retained earnings. The main goal of capital structure is to maximize the value of the firm while minimizing the overall cost of capital. Example: if a company has 50 lakh rupees in equity, 30 lakh rupees in debt, and 20 lakh rupees in preference shares, its capital structure is 50% equity, 30% debt, and 20% preference shares. A good capital structure balances risk and return. Using more debt may lower cost due to tax benefits but increases financial risk, while using more equity reduces risk but may be costlier. Major determinants of capital structure. 1. Cost of capital. Companies prefer funds with the lowest cost. Debt is cheaper due to tax deductibility of interest, whereas equity is more expensive. 2. Financial risk. High debt increases the risk of default. Companies with stable earnings can afford more debt, while risky businesses rely more on equity. 3. Flexibility. Companies need financial flexibility to raise funds in the future. A rigid capital structure may limit growth. 4. Control considerations. Issuing more equity can dilute control of existing owners, so companies may prefer debt to retain control. 5. Nature of business. Capital-intensive industries, example, manufacturing, may need more debt, while service industries rely more on equity. 6. Market conditions. Favorable stock markets encourage issuing equity, while low interest rates favor debt financing. 7. Companies' growth rate. High growth firms may use more equity to avoid excessive debt risk. 8. Profitability. Profitable companies may use retained earnings, reducing dependence on external funds. 9. Regulatory and legal factors. Some industries have limits on debt or equity. Easy way to remember. Think of capital structure as a finance recipe. The right mix of debt and equity gives the company a tasty balance of low cost and low risk. Too much debt burns the recipe, risk. Too little debt may taste bland, expensive capital. In short, a well-planned capital structure maximizes shareholder wealth while keeping the company financially healthy. Next important long question is 3. Define dividend and discuss determinants of dividend policy. Dividend and determinants of dividend policy. Definition of dividend. A dividend is the portion of a company's profits distributed to its shareholders as a reward for investing in the company. It can be paid in cash, cash dividend, or in the form of additional shares, stock dividend. Dividends reflect the company's profitability, financial health, and management's confidence in future earnings. Example, if a company earns 10 rupees per share and decides to pay 4 rupees per share as a dividend, shareholders receive 40% of the profit. Determinants of dividend policy. Dividend policy refers to the guidelines a company follows in deciding how much profit to distribute as dividend and how much to retain for business growth. The key factors influencing dividend policy include 1. Profitability of the company. A company with high and stable profits can pay higher dividends. Startups or growing companies with fluctuating profits may retain earnings. 2. Cash flow position. Adequate cash is essential. Even profitable companies may cut dividends if cash is needed for operations or debt repayment. 3. Growth opportunities. Companies with expansion plans often retain more profits for reinvestment rather than paying high dividends. 4. Stability of earnings. Companies aim for a stable or gradually increasing dividend to maintain shareholder confidence. 5. Shareholder preferences. Some investors prefer regular dividends, while others may prefer capital gains through retained earnings. 6. Legal and contractual constraints. Companies must comply with legal provisions and loan covenants that may limit dividend payouts. 7. Tax considerations. Dividend policies may be influenced by the tax treatment of dividends for shareholders. 8. Inflation and economic conditions. During high inflation or uncertain markets, firms may retain earnings to protect financial stability. 9. Market expectations and signaling. Paying consistent dividends signals financial strength and good management to the market. Easy way to remember. Think of dividend policy like sharing a cake, how much to give to friends, shareholders, now and how much to save for baking a bigger cake later, business growth. In short, dividend policy balances rewarding shareholders and funding future growth, ensuring the company stays healthy and investors remain confident. Next important problems is 4. A firm has the following capital structure and after-tax costs for the different sources of funds used. You are required to compute the weighted average cost of capital. Weighted average cost of capital, WACC, calculation. Problem. We are given a firm's capital structure. Source of funds amount, rupees proportion percent after tax cost percent. Debt 15 lakhs 25.5. Preference shares 12 lakhs 2010. Equity shares 18 lakhs 3012. Retained earnings 15 lakhs 2511. Total 60 lakhs 100. We need to compute the weighted average cost of capital WACC. Step 1. Formula of WACC. WACC is equal to proportion of fund times cost of fund. Here, each source's proportion is already given in percentage terms. Step 2. Multiply each source's cost by its weight. Debt is equal to 1.25%. Preference shares is equal to 2%. Equity shares is equal to 3.6%. Retained earnings is equal to 2.75%. Step 3. Add all weighted costs. WACC is equal to 9.6%. Step 4. Conclusion. The firm's weighted average cost of capital, WACC, is 9.6%. Easy way to remember. Think of WACC as a blended interest rate. You take the cost of each fund, weigh it by its size, and add them up. It tells the company how much, on average, it costs to raise money from all sources. Debt is cheaper due to tax benefits. Equity is expensive. Retained earnings are slightly cheaper than new equity but still part of overall cost. This WACC is important for investment decisions. Projects should earn more than 9.6% to create value. Next important problem is 5. The following information is available in respect of a firm. Capitalization rate is equal to 10%. Earnings per share is equal to 50 rupees. Assumed rate of return on investments. 1. 12%, 2. 8%, 3. 10%. Show the effect of dividend policy on market price of shares applying Walter's formula when dividend payout ratio is 1. 0%, 2. 20%, 3. 40%, 4. 80%, V. 100%. Effect of dividend policy on market price of shares, Walter's model. Given. Capitalization rate, K, is equal to 10%. Earnings per share, E, is equal to 50 rupees. Internal rate of return, R, is equal to 12%, 8%, 10%. Dividend payout ratios, DE, is equal to 0%, 20%, 40%, 80%, 100%. We will calculate the market price of share, P, using Walter's formula. P is equal to D plus ED, RK, K. Where D is equal to dividend per share. E is equal to earnings per share. R is equal to return on reinvested earnings. K is equal to cost of equity. Step 1. Case RK, 12% greater than 10%. When the firm earns more on reinvested earnings than cost of equity, it should retain more earnings. Dividend payout 0%, D is equal to 0. Retained earnings is equal to 50, P is equal to 60. Dividend payout 20%, D is equal to 10. Retained is equal to 40, P is equal to 58. Dividend payout 40%, D is equal to 20. Retained is equal to 30, P is equal to 56. Dividend payout 80%, D is equal to 40. Retained is equal to 10, P is equal to 52. Dividend payout 100%, D is equal to 50. Retained is equal to 0, P is equal to 50. Observation: price falls as dividend increases because reinvestment earns more than cost. Step 2. Case RK, 8% less than 10%. Here, firm earns less on retained earnings than cost of equity, so paying more dividends increases price. 0% payout, P is equal to 40, retained earnings lost value. 100% payout, P is equal to 50, All dividends paid, max price. Observation, price rises with higher dividends. Step 3. Case R is equal to K, 10% equals 10%. Market price remains constant for any dividend payout, P is equal to 50. Key takeaways, easy to remember. RK, retain earnings higher share price. RK, pay dividends higher share price. R is equal to K, dividend policy doesn't affect price. Walter's model shows dividend policy affects market price only if internal return differs from cost of equity.